Hey there, money mavens, it's your boy Jim Cramer here to break down a topic that's more important than a good hair day on Wall Street: the Federal Reserve and its impact on the stock market. The Federal Reserve, also known as the Fed, is like the conductor of the US economy. They set the tempo for borrowing and lending money. Think of them as the big kahuna of interest rates. But why should you care? Because the Fed's decisions can make or break your portfolio. So buckle up, Buttercup, because we're diving deep into the world of interest rates and stock market shenanigans. Now, let's talk about interest rates. These are the fees charged by lenders to borrowers for the use of money. The Fed doesn't set all interest rates, but they control a key one called the federal funds rate. This rate is like the benchmark for all other interest rates in the US. When the Fed raises the federal funds rate, it becomes more expensive for banks to borrow money, and that cost gets passed on to you and me. On the flip side, when the Fed lowers the federal funds rate, borrowing becomes cheaper, encouraging businesses and consumers to spend more. It's all about finding that sweet spot to keep the economy humming. The Fed's interest rate decisions are like throwing a pebble into a pond. They create ripples that affect the entire economy. When rates go up, borrowing costs rise, which can slow down inflation. But here's the catch: higher rates can also put a damper on economic growth. Businesses may postpone expansion plans, and consumers might think twice about taking out loans for big purchases. Conversely, lower rates can stimulate growth by making it cheaper to borrow and invest. However, if rates stay low for too long, it can lead to inflation, where prices rise faster than wages. It's a delicate balancing act. Now let's talk about the stock market, the ultimate casino for your capital. The relationship between interest rates and stock prices is like a complicated tango. They move together, but sometimes they step on each other's toes. Generally, when interest rates rise, stock prices tend to fall. Why? Because higher rates make it more expensive for companies to borrow money, which can cut into their profits. Moreover, higher rates make bonds more attractive to investors seeking a safe haven for their money. This can lead to a shift of funds from the stock market to the bond market, putting downward pressure on stock prices. Section 5. Rate hikes and market jitters, a historical perspective. Remember the dot-com bubble of the late 1990s? It was a time of exuberance and unprecedented growth in the tech sector. Companies with little more than a business plan and a .com in their name saw their stock prices skyrocket. Investors were caught up in the frenzy, pouring money into tech stocks with the hope of striking it rich. The Fed, under the leadership of Alan Greenspan, raised interest rates to cool down the overheated economy. And guess what? The higher borrowing costs started to weigh on the market. Companies that had been thriving on easy credit found it harder to finance their operations. The stock market took a nosedive. The bubble, which had been inflating for years, finally burst. Stock prices plummeted and many tech companies went bankrupt almost overnight. It was a stark reminder of the risks of speculative investing. Investors panicked and the bubble burst. The aftermath was brutal, with trillions of dollars in market value wiped out. Many investors lost their life savings and the economy slipped into a recession. Fast forward to 2004 to 2006, the Fed, now under Ben Bernanke, embarked on a series of rate hikes to combat rising inflation. The economy was recovering from the dot-com bust, but inflationary pressures were building. The stock market initially shrugged it off, buoyed by strong corporate earnings and economic growth. But eventually, the weight of higher borrowing costs took its toll. Companies faced higher expenses, and consumer spending slowed down. Stocks began to decline, reflecting the growing economic uncertainty. These are just a couple of examples of how the Fed's rate hikes can send shivers down the spines of investors. The central bank's actions have far-reaching consequences, influencing everything from mortgage rates to the cost of borrowing for businesses. But hold on, it's not always doom and gloom. There have been times when the Fed's rate hikes have been seen as a sign of a strong economy, leading to investor confidence and market gains. It's a delicate balance, and the Fed's decisions are always closely watched by market participants. Section 6. When rates go down, stocks often go up. When the Fed lowers interest rates, it can be like a shot of adrenaline for the stock market. Lower rates make it cheaper for companies to borrow money, boosting their earnings potential. Investors get excited about the prospect of higher profits and pour money into the stock market, driving prices higher. It's a beautiful thing, like watching your favorite stock soar to new heights. But remember, the stock market is a fickle beast. Other factors such as economic growth, corporate earnings, and global events can also influence stock prices. Section 7. The tech bubble burst and the Fed's response. Let's rewind to the aftermath of the dot-com bubble burst. The early 2000s were a tumultuous time for investors and tech companies alike. The dot-com bubble, which had seen the meteoric rise of internet-based companies, came crashing down, wiping out trillions of dollars in market value. Investors who had poured money into these high-flying tech stocks were left reeling as the market plummeted. The Fed stepped in to save the day, slashing interest rates to stimulate the economy and prevent a full-blown recession. Under the leadership of then Federal Reserve Chairman Alan Greenspan, the central bank took decisive action. By lowering the federal funds rate, the Fed aimed to make borrowing cheaper, encouraging businesses to invest and consumers to spend. These rate cuts, along with other government measures, helped to cushion the blow and eventually led to a recovery in the stock market. The lower interest rates made it easier for companies to access capital, which in turn helped to stabilize the economy. Over time, the stock market began to recover, and investor confidence slowly returned. It was a classic example of the Fed's power to influence market sentiment. The central bank's actions demonstrated its ability to act as a stabilizing force during times of economic uncertainty. By signaling its commitment to supporting the economy, the Fed was able to reassure investors and help restore confidence in the financial markets. However, it's important to note that the Fed's actions don't always have an immediate impact. While the rate cuts were instrumental in the eventual recovery, the road to stability was not without its bumps. Economic indicators took time to show improvement, and the initial response from the stock market was mixed. The stock market can remain volatile in the short term, even when the Fed is trying to steer it in the right direction. Investors often react to a multitude of factors, including global events, corporate earnings reports, and geopolitical tensions. As a result, market volatility can persist despite the Fed's best efforts to provide stability. Understanding this dynamic is crucial for investors looking to navigate the complexities of the financial markets. Section 8. The 2008 financial crisis, a rate cut roller coaster. The 2008 financial crisis was a wild ride for the stock market, and the Fed was at the helm of the roller coaster. The crisis began with the bursting of the housing bubble, which led to a cascade of financial failures. Banks were over-leveraged, and the interconnectedness of global financial institutions meant that the collapse of one could trigger a domino effect. Investors were in a state of panic, and the stock market reflected this fear with extreme volatility. As the crisis unfolded, the Fed slashed interest rates to near zero to prevent a complete economic meltdown. These rate cuts were part of a broader strategy known as quantitative easing, which involved the Fed purchasing large amounts of financial assets to inject liquidity into the economy. The goal was to lower borrowing costs for businesses and consumers, thereby stimulating economic activity. These unprecedented rate cuts, along with massive government bailouts, helped to stabilize the financial system and avert a global depression. The government stepped in with the Troubled Asset Relief Program, TARP, which provided capital to banks in exchange for equity stakes. This infusion of capital was crucial in restoring confidence in the financial system, but the stock market still experienced a heart-stopping plunge before eventually recovering. The Dow Jones Industrial Average lost more than half its value at the height of the crisis. It was a period marked by uncertainty, with investors unsure if the market had hit bottom or if further declines were imminent. However, over time, the market began to stabilize and eventually embarked on a long road to recovery. The 2008 crisis highlighted the crucial role the Fed plays in times of economic turmoil. The Fed's actions were not without controversy, as some critics argued that the rate cuts and bailouts created moral hazard, encouraging risky behavior by financial institutions. Nonetheless, the Fed's intervention was widely credited with preventing a much worse economic outcome. Their actions can make the difference between a recession and a depression, between a market correction and a full-blown crash. The 2008 financial crisis serves as a stark reminder of the delicate balance the Fed must maintain in its dual mandate of promoting maximum employment and stabilizing prices. The lessons learned from this period continue to influence monetary policy decisions to this day. Section 9. Conclusion: Navigating the Fed's impact. So, there you have it, folks. The Federal Reserve's interest rate decisions have a profound impact on the U.S. stock market. Higher rates can put downward pressure on stock prices, while lower rates can provide a boost. But remember, the market is a complex beast, and other factors are at play. It's essential to stay informed, do your research, and consult with a financial advisor before making any investment decisions. And always remember, as your friendly neighborhood market commentator, I'm here to help you navigate the exciting and sometimes terrifying world of finance.